Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Tom Lydon, editor of ETF Trends, Todd Rosenbluth of CFRA. All the major indices under pressure today as escalating trade tensions and economic growth concerns continue to weigh on stocks. Dow falling more than 200 points right now. Recent volatility is fueling a debate on whether investors should stick with the cyclical trade or start getting more defensive with their portfolio. Just where's the best place to put your money? Todd, we've been debating this all year. Recently, defensive names, your consumer staples, have been holding up well. But if we get any resolution to the trade issue, defensive names are going to do better. Where do you stand on this?
So we at CFRA like this new ETF that came out from Direxion. It's a cyclical over defensive ETF, RWCD. It favors the cyclical side, so the technology, the financials, the consumer discretionary. It's long that, and it's short the defensive ones like utilities and consumer staples. We do think that the economic growth picture is going to improve. Earnings picture is going to be quite strong, and this is a compelling way of getting exposure to that in one ETF as opposed to building it yourself.
And I misspoke a moment ago. I meant cyclical should be better over defensive. Tom, what about some of these new ETFs? This one Todd is mentioning here, the RWCD, I think is the symbol there. Cyclicals over defensive. So 1.5 times long some of the cyclical names. So you own Amazon and Microsoft and things like that, and you're short partly the defensive names like consumer staples names. Is there a future for this kind of ETF? I like the idea. At least you make it a clear bet.
You are, and Direxion's done a great job of putting the suite together. They have 14, so you can actually go growth or value, or you can go domestic or international. Again, as you point out, 150% long. And then on the short side, it's 50%. So you're a net 100% long, kind of creative in that strategy.
Yeah, and you can't, I mean, look, it's a bet. At least it's a pure play bet of some kind, Todd. That's what I like about it. It's hard to say, well, against the S&P, because it's going to go up and down depending on the circumstances. But if you have conviction, I like the way it's set up.
Yeah, a way of making sure that you're targeting your exposure. So you'll find that growth-oriented ETFs are a way people tend to play cyclical. But within growth-oriented ETFs, you're going to have a variety of sectors, but you're also not going to have financials in Vanguard growth ETF. Or you could play the defensive side of it with utilities or dividend-oriented stocks. But again, you're going to have a mix of it. This allows you to be more targeted. And Direxion's one of the firms that stood out. We've seen a number of the larger firms stay on the sidelines in launching new products in 2019.
There's no shortage of new products, and not just things like making bets, but even individual concepts. So recently, iShares launched a self-driving ETF device. IDRV is the symbol. So you own Google, you own the autos. I don't know why you don't own Tesla in a big way, particularly, but the problem I have with this is how much of a revenue of self-driving is there really in owning Alphabet or any of the automobiles? You can't really. There's nothing there to grab onto. It was like getting involved in cryptocurrencies 3 or 4 years ago. There's nothing really to buy.
This is one of these things where ETFs are hugely popular. Most advisors say they're going to be their go-to investment. Thematic ETFs continue to be really, really strong. However, as you point out, you have to look under the hood and make sure that the bottom line of those companies affect the overall objective of the ETF. In this case, it's clearly not the case.
Yeah, do you have the same feeling? I'm all in favor of more research on self-driving cars. I'm more in favor of companies that are doing it. I just don't see a lot to buy, and I certainly don't see how owning a chip stock is going to make it a big dent in you owning self-driving cars. It's not going to. It doesn't help. These
are some of these longer-term themes that you have to get in early with some of these companies. But you, as Tom mentioned, you do really need to look under the hood, make sure you understand what is inside the portfolio.
Yeah, let's get to the flow down here. I want to just chat about a big theme here that's emerging. The ETF market is exploding. You know that. We've got more than 2,000 listed funds out there. We've got $4 trillion in assets roughly overall around the world. But their popularity also could be a source of their downfall. Increasing competition. Fee wars is putting the industry on the verge of a do-or-die moment. ETF manager Wisdom Tree, which we often use as a proxy for the overall business, is feeling the heat. They're a publicly traded company for a long time. Stock tumbling more than 20% this year, hitting lows not seen since 2011. Again, this is roughly a proxy for the ETF business. Are ETFs becoming a victim of their own success? We've seen fee wars. We've seen active managers losing. We've seen rising costs recently. All this is good news for the average investor. But we're going to see some consolidation.
We're going to see consolidation, and we are seeing a lot of M&A go on. We saw Guggenheim and Oppenheimer get picked up by Invesco. Everybody wants to be in the ETF space, Bob. There are a lot of companies. USAA just got picked up by Victory, and there are only a very few publicly traded companies that are specifically in the ETF space.
We have almost 200 ETF companies out there, Todd. Are we going to see that? We keep talking about it eventually. We've been doing this. We did this last year. This is going to collapse eventually, but it doesn't.
Yeah, the big five, starting with iShares and going down to Schwab, have the vast majority of the assets, the vast majority of the inflows are going into their low-cost products. 95% of all new money in 2019 has gone into ETFs that charge 20 basis points or less. So if you are going to charge more than that, you have to have something unique in the marketplace. We touched on that relative weight approach to it. We're going to talk about actively managed ETFs. You have to stand out. We are going to see some of these firms that entered the market have failures to be able to do so, and they're going to end up shutting the doors.
As a consumer, I know we talk about this as the business because it's affecting asset managers, obviously, but for the average consumer, does it matter that much? Or I know we watch the industry because we have friends in this business, and that's a problem, but does it matter? The consumer's still getting a great deal. I don't see any imminent collapse of the ETF business at all. I see too much competition and the likelihood that a lot of players might go away.
It's not going away anytime soon. And as you point out earlier, who wins? The end investor. This fee war has done great things for the average investor. More diversification, better tax efficiency. And as we know, we've talked about it, there's this non-transparent ETF that's going to be coming to market where they've got 13 to 15 companies that are lined up. We'll see how that does, but a lot of people would be loving to be in the ETF space these days.
Yeah, right now. All right, I'm going to move on here. Despite issues with tariff and trade, technology and growth are dominating the market, but where is the new tech leadership? Where's the next FANG stocks? Cathie Wood is paid to know where to find those opportunities. She's a regular here. She's the founder and CEO of Ark Investment. Cathie runs the firm's Ark Innovation ETF, an actively managed fund that targets companies poised to benefit from disruptive innovation in one of three areas: industrial innovation, genomics, or Web X.0. And, we always talk about the triumph of passive over active. Well, your active fund, here's an active manager that's been doing very well. How is Ark your flagship? It's up 20% this year. You're outperforming. You've got big bets on Tesla. I know you've had to defend that, and a lot on the genomics business.
Yes. In fact, I think many people would be surprised to learn that our top sector, if you measure us by sectors, we don't look at sectors because we think technology is blurring sectors, is healthcare. And that's because the genomic space, we're on the threshold of curing diseases. And it's happening because of DNA sequencing and CRISPR gene editing. But these companies are not valued as though that is actually going to happen. The three major CRISPR companies, Intellia, Editas, and CRISPR Therapeutics, they own the foundational patents. All together, they amount to $5 billion in market cap.
Why doesn't the market give them given the potential impact on the economy and on healthcare, why doesn't the market give them higher numbers? Why aren't they worth more?
What's so interesting about this period is the seeds for this revolution were planted in the tech and telecom bubble, and that's when investors were chasing the dream. The dream is now reality, and investors are fearful of many things, mostly because the market has been in an uptrend for 10 years, and we've got hot spots around the world, whether it's China or Europe or inverted yield curves and so forth.
But if everyone's going to use this technology, $5 billion seems like a pretty modest amount for the three biggest CRISPR companies.
If you're talking about curing disease, absolutely.
Not all of them are doing well. Illumina had some problems recently.
Yes.
That's a big holdings of yours.
Yes,
now,
it
here's
is.
some company that does the gene sequencing.
Foundational.
They had a problem, but it's a big holding of yours. 20 seconds on your take here.
6% growth is not what this company is capable of. We know, the CEO knows, Francis D'Souza, that he needs to cut prices, cut costs, because his own costs are coming down. He can cut prices and cause an explosion in genomic sequencing. Last year, there were 2.4 million genomes sequenced in the world, human genomes. That's half of all the human genomes ever sequenced. That tells you we're in an exponential growth trend. And we think that's going to 100 million in 5 years. That's a 40-fold increase as costs come down 30 to 40% per year. He has to drive those costs into the pricing structure.
I want to get these two guys involved, but I just want to ask you about your number one holding, which is Tesla,
Yes.
which has obviously had a tough year. You've been a vehement defender of Tesla,
Yes.
and very eloquent in it. Are you still as enthusiastic as you were a year ago?
Absolutely. I think we're in a whack-a-mole period where the bears out there are whacking the latest mole. They get production going, then the bears worry about demand. They get demand going, then the bears worry about cash. They do a deal, then the bears worry about margins. We've just done a gross margin study, and we think their gross margins could go up if they keep pricing where it is in the Model 3 to 30% from roughly 17% in this year. So we're pretty excited about Tesla. We think the negative sentiment is pretty unbelievable. And you know what? It is disingenuous at best for those who think Google's Waymo should be worth 45 to 65 billion. When Tesla is so far ahead of Waymo and cruise automation.
The market seems to have a really
autonomous.
tough time even vaguely understanding how to value this. And what was it, 350 a year ago? It went down to half that. It was almost 175, and it's higher now. I think you just put up a chart. It's 210, I think. But that when you're cutting half in a year and then you start coming back, that tells you the market doesn't have any idea what.
This is another great example.
How to value the company.
Another great example of the difference between the tech and telecom bubble, where you did have investors looking to the future instead of the past. The new EV ETF you mentioned, if you look, most of those auto companies are either going to disappear or be absorbed by some bigger, maybe tech company. I don't know. Tech companies are going to dominate autonomous, and it's really unbelievable that Tesla's not
I love
in the
her
top 10.
enthusiasm.
Yeah, she's on top of all of these things. I guess the question, though, guys, is genomics the next FANG, essentially? Would you make that argument?
I think what's going on in the genomic space is quite provocative, and I think the disconnect out there is most of the seasoned, the best healthcare analysts have been in their positions for years and years. Our analysts came out of college pretty recently and have experimented with CRISPR gene editing. And so they have much higher conviction that it's going to work. They've seen it work. They've seen it work in plants, and we're in our first human trials. They believe it's going to work in human beings. And this is going to the first, one of the first trials.
What we need here is more revenues, essentially, to ramp up. We need more people using these technologies, essentially.
If Editas is able to show this year, first milestones we'll see this year, that it is being successful, its editing is successful in curing pediatric blindness, these stocks are not going to be $5 billion in market cap once those results come out. And we think they're going to be positive.
But you believe in the efficacy of the CRISPR technology.
Absolutely.
I follow it. The science makes absolute sense to me. Obviously, you have to be careful because we don't really understand the knock-on effects when you're treating people, when you're trying to snip out little pieces of their genes and reinsert them, which is what CRISPR technology does. So obviously we have to be careful. But
no one believes this is going to work. That's why these are priced the way they are. So what you say, all the risks, all the potential risks you're talking about have been baked in.
Okay.
I'd have to question that, though, just because we've seen the stock, obviously, Illumina, for example, fell sharply after it reported the slowest growth that it's seen in 2012. Tesla, as you showed earlier, fell sharply. These are growth stocks, but when the growth stocks slip, they slip quite hard, and investors need to make sure they understand that, as Cathie mentioned, that they're looking forward, not just at the past track record.
And how do you deal with that? How do you deal with exactly what he said, what happened with Tesla and with Illumina?
Well, our time horizon is a 5-year time horizon. Our price targets have actually gone up in the last 6 months. Our bear case is around $600. And our bull case is, I know we're known for $4,000, it's actually gone up to $6,000.
All right, you heard of genomics, that's the future, and I agree. I think the next FANG is genomic stocks in general, and I think that makes absolute sense for me. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Todd Rosenbluth, Tom Lydon, Cathie Wood for joining us today, and thank you for watching. You'll find all of our latest videos here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.